Welcome to the latest edition of the DBS webinar series, Insurance Insight, designed to give you the tools and information you need as a financial professional. Sit back as we tackle the hottest topics in life insurance, breaking industry news, and leading sales ideas to help you better understand the products and services that will help you help your clients. Now, here's your host, Kurt Fasen, Executive Vice President of Sales and Marketing.
Hello, and welcome to another edition of Insurance Insight. My name is Kurt Fasen, Executive Vice President at DBS, and I appreciate you taking time out of your day to join us again. Today, we're going to talk about a topic that I think always has a lot of interest to financial professionals. It's how to help clients prepare for retirement. We're going to add to this and make it a little bit more about the flexibility of retirement strategy, which is all about helping clients structure their retirement income to include a variety of sources for their retirement. And as you know, life insurance can really provide a great option for diversification of your retirement income funds. So join me today to dig into this concept a little bit further is Vern Carlson, National Sales Manager of the Life Division at MassMutual Strategic Distributors. Vern, welcome to the show.
Kurt, thanks for having me. It's great to be with you today.
Absolutely. All right, well, let's get started. Now, for those of us joining us, they probably have seen articles online or read them that a lot of strategies stress the importance about saving for retirement. That's a common theme. And I think financial professionals really have to address this with their clients. So let's talk about how they can be more effective at really bringing this conversation up. Can you talk to us a little bit about maybe a simple way in which advisors can help their clients really realize the need for saving?
Yeah, absolutely, Kurt. I think it's a great thought because I think there's a really simple way that you can illustrate the need for saving in retirement. I think it's to focus in on meals because the hypothetical 65-year-old couple that everybody likes to talk about when it comes to financial planning, I don't think most people realize if they were to spend just $5 per meal for the next 20 years in retirement, that couple is going to spend $218,400 just to eat. And by the way, that's pretty hard to do in this environment when you consider inflation.
Wow, that's a staggering number. Now there's always more to the story. So let's talk about what are some of the other things that advisors should factor into that client discussion.
Yeah, well, again, I'm gonna use that hypothetical 65-year-old couple because it's the one we all like to talk about. If you were to assume that they're healthy, that's a couple that's expected to spend somewhere in the neighborhood of about $315,000 or more on healthcare costs in retirement. But then you've also got to consider that people are living much longer, healthier lives. It's really a coin flip probability that one of these people is going to live beyond age 90. And if they're non-smoking and healthy, it's still a coin flip probability that one of them is going to live beyond age 95. So again, it's all good news. You just have to plan for it.
Well, I think you're hitting on an important aspect of retirement, and that's the longevity risk, right? Depending upon which side of the coin you're on, you might need money longer than you think. So let's talk about longevity and how that would impact a couple's retirement planning.
Sure. Yeah. I mean, there's a recent study that was done that shows that nearly 70% of Americans at some point are going to deal with a long-term care event. And then on average, that's a claim that's typically going to last about 3 years. When you also factor that the average cost of a private room in a facility today runs just under $9,000 per month, now you're factoring in an additional, that's $108,000 per year. Again, the average claim is 3 years. You're looking at another $324,000 that you have to factor into this journey. And so to refer back to where we just started this conversation, that couple that's expected to spend $218,400 just to eat, another $315,000 or more for healthcare expenses in retirement, and then this $324,000 that we just talked about relative to a potential long-term care event, we're over $850,000 into this expected retirement journey. And I can guarantee you that this hypothetical 65-year-old couple, they're not even thinking about really, how they want to live their life in retirement, where they want to spend it and who they want to spend it with. I mean, it's a totally different mindset when you think about, just numbers and the sheer totality of what this story means for these clients.
Well, Vern, I really think breaking it down like that brings it kind of into a scope of reality. I mean, sometimes when people think about retirement, I mean, it just becomes so big they can't even get their arms around it. So I like the way you're breaking it down into bite-sized pieces. But even with that, I mean, $850,000, that's a staggering number. That got my attention. I'm sure everybody joining us today got their attention as well. Now, we really need to advance the planning conversation forward a bit. We just focused on the example of the 65-year-old hypothetical couple. Now, risks are present throughout the client's life, so maybe we should talk about that a little bit.
Yeah, I mean, a good way to think about that, Kurt, is really to think about any important decision you've made in your life. And chances are, you've taken a piece of paper and you've drawn a line right down the middle. And on the left side, you put the word pros, and then on the right side, you put the word cons. And that's what I want anybody who's listening today to think about when you talk about wealth management risks. And it's, the left side of the page, I want you to write the words pre-retirement. And then on the right side, I would suggest writing the word retirement. And I'm sure every single person that's listening today can think back to important milestones in each one of our lives. And whether it was, getting married, or could be having children, or even buying our first home, those are amazing moments, but they also bring on additional risks. And so when you think about risks on the left side of the paper, I would write the words income replacement, mortgage protection, and then college funding. Because if I prematurely pass away, those are three risks that are enormous. They're massive, especially as I achieve milestone moments like getting married or buying home or having kids. I have to protect my family immediately. And the most common protection solution that's used to mitigate these three risks is term insurance. So again, all massive risks in my pre-retirement years, but they actually decrease in terms of importance the closer I get to retirement. And so now as you move over to the right side of the page, what I would suggest to think about here is, what are the retirement risks that we face? And there's really three key primary risks that I want everyone to consider. And first, it's financial risk. Second, it's healthcare costs in retirement. And then third, it's something that I refer to as Social Security survivor income. Because when I think about financial risk, it's not just market interest rate or even inflation risk. It could be something as simple as a 72-year-old who's on a fixed income. They've got an unexpected roof repair due to a major storm. And that's something that's really, really hard to plan for, in addition to all the other financial risks that this individual or these individuals would face if it's a couple. And then I hit on this one earlier, so I don't need to, beat the dead horse, so to speak, but healthcare risk. We covered that earlier when we talked about that hypothetical 65-year-old couple that's expecting to spend probably $315,000 or more. And so generally, kind of what I like to say is here, we all have an expiration date, and we just don't know when that expiration date is. But the longer I live, the more risk I face as it relates to healthcare costs and retirement. Right. And then finally, that third risk on kind of that right side of the page there, and I don't think it gets talked about enough, Kurt, it's Social Security survivor income risk. Because if I predecease my spouse as the primary breadwinner in my family, she's going to end up seeing about a 33% reduction in Social Security survivor income. That's massive. And so when you put all three of these risks together, I think you can see how they have the ability to impact someone's financial portfolio when we look at their entire wealth management life cycle. And so going back to your question about, addressing risk, I think it's vitally important to get into a conversation about creating a portfolio of insurance products, not just a transaction of insurance, but a portfolio of insurance products that meets client needs across their entire wealth management life cycle. I think it's fundamental to the planning process. And that protection that they can end up needing for their lives could include both term as well as permanent insurance. And on the permanent side, that could include participating whole life. It could include index universal life and even variable. So, lots to consider for clients as it relates to addressing risk.
Wow, there really is. And when you think about that, it really is a journey that people need to take time to think about, and their advisors, like the ones joining us today, you need to make sure you're helping them understand those risks. I think we're clearly on a journey in this discussion to help create more certainty for clients during their entire wealth management life cycle. Now, we've just discuss creating a proper portfolio of insurance. I like that phrase, a portfolio of insurance. Is there a way that advisors can highlight the impact of that protection portfolio when discussing?
Yeah, it's a great question, Kurt. And I think a really good place to start here is with an idea that JP Morgan calls dynamic spending. And what you'll see when you look at JP Morgan's dynamic spending idea is that it has nothing to do with life insurance. That's like literally the first thing that you're going to see. And that's why I love it, because I believe it has everything to do with life insurance. And so here's why. Because when you look at their idea of dynamic spending, what you're talking about is a hypothetical 65-year-old who's heading into retirement with $1 million. And they're looking at a portfolio, assuming that the composition switches to a more conservative allocation of 40% equities and 60% fixed income. The portfolio is then back tested from 1966 to 2000. And again, this hypothetical client is starting their retirement with an initial withdrawal rate of 4%. They index that up for inflation each year. And what you end up finding is that the portfolio is exhausted before the client reaches age 90. And so what you'll end up seeing is that, the pivot really is to an idea that they call dynamic spending. And simply, it's an idea that means the client should vary his or her rate of withdrawal based on portfolio performance. So if performance is less than 5%, then they recommend no change in next year's withdrawal. Performance between 5 and 10% would result in an increase aligned with inflation. And then finally, any performance that's greater than 10% in the portfolio shows the withdrawal increasing by inflation plus an additional 3%. So it's a fascinating idea, but again, you realize I said nothing about life insurance just now.
I love that idea, though. The fact that it's dynamically moving with the returns from the portfolio. But in your comments about dynamic spending, you said it has nothing to do with life insurance. Maybe you want to expand on that thought just a little bit.
Yeah, I mean, look, with this hypothetical client, again, using real back-tested returns over a 35-year period, we clearly see that there's a better outcome reached for the client over a longer period of time by varying their rate of withdrawal. And I just think to myself, man, how much more powerful would this idea be if they were to incorporate an asset that can be accessed on a tax-favored basis that isn't subject to the same interest, inflation, and market volatility as other assets? And you can do just that with participating whole life insurance, because it offers the one thing that other products don't have the ability to offer, and that is a guaranteed cash value component that never goes down and it only goes up. So it truly, that non-correlated aspect of the portfolio is really, really powerful.
Well, Vern, that makes a lot of sense. And I guess, you do represent MassMutual. So for everybody who's joining us, they were expecting you to talk about the power of participating whole life. Maybe you could talk about any resources that could point them really to talk more about how participating whole life works, and maybe something they could get even if they're not on the payroll at MassMutual.
Yeah, no, it's a good question. I'm glad you asked it, because in late 2022, there was a study that was done by Ernst & Young, and it talked about creating more consistent and predictable outcomes for clients, both on the income side of retirement as well as legacy planning. And what they found with a 90% probability level of success is that the optimal portfolio mix was 30% deferred income annuities with rising income potential, and then 30% what they refer to as PLI, which is permanent life insurance. And if you dive into the white paper, they specifically talk about the PLI component, permanent life insurance, being participating whole life insurance as that particular component. So they don't talk about a specific product or a mutual carrier, but they talk about the power of buying essentially the balance sheet of a quality mutual company, and then the ability to offer non-guaranteed policyholder dividends. And then the balance of that equation, so it's 30% deferred income annuities with rising income, 30% PLI, which again in this equation leverages participating whole life, and then 40% traditional investments. So it's really powerful when you think about it, right? An industry study talking about the power of a non-correlating asset to the rest of the portfolio known as participating whole life insurance. So look, I mean, participating whole life, it not only provides a death benefit when the client passes away, but it also provides flexibility and access to cash value that isn't subject to the same interest, inflation, and market volatility as other assets that a client may hold. So I kind of go back to where I started when you asked me about, a way that advisors can highlight the impact of a protection portfolio. And while I believe dynamic spending may have nothing to do with life insurance, when JP Morgan was creating that idea, I believe, as you can see, I think it has everything to do with life insurance. So one other thing, Kurt, if you don't mind me mentioning this, we actually have a tool that I would be remiss if I didn't bring up, because we created a tool that really helps tell the story. It's a tool called Simplify, and there's a module in Simplify called Taming a Bear that helps advisors really drive home the importance of a non-correlated asset in the portfolio. And your team of financial professionals that you work with at DBS, they can deliver that content because of your relationship with MassMutual Strategic Distributor. So I just wanted to point that out.
That's great. That's great. So to recap where we are thus far. So we talked about a simple way to help clients really understand the need for saving. Then we hit on the importance of managing risk during the entire wealth management life cycle. And then we just added in the layer about dynamic spending and the power of introducing a non-correlated asset. That's a lot, but I think it's good. And so that really brings us to the importance of diversification. How should we think about diversification in the context of the discussion we just had, Vern?
Yeah, I would suggest that really any advisor or financial professional walk their client through a simple exercise to really highlight the importance of diversification. And one of my first mentors in the business taught me this story, and it's really, I feel, what I would call kind of a timeless idea. And if you ask any client where their assets currently sit today, depending on the asset and tax treatment, they sit in either a taxable, tax deferred, or a tax favored account. And oftentimes, clients are going to indicate that most of their assets sit in either a taxable or a tax deferred account, because truthfully, that's how people are conditioned to save, is through payroll deduction. But here's the challenge. Nearly 100% of those assets are going to be 100% taxable at a point in the future that a client can't predict.
So why do you say that, Vern?
Well, I mean, because currently, look, we've got a $34.8 trillion national debt, and that number continues to climb every day. We're dealing with entitlement program solvency questions, one of them revolving around Social Security. Social Security is projected to become insolvent in the next 10 to 12 years. So we're facing tremendous macroeconomic challenges. And so the question to the client really becomes, Mr. or Mrs. Client, do you think taxes are more or less likely to go up or down in the future? And before they answer, I would highly ask them to consider the fact that the average top marginal federal tax bracket, when you look over the last 100 years here in America, sits at just under 60%.
Oof.
So again, yeah, I mean, the question really is, given all the challenges that we just mentioned, are taxes going up or going down? And I got to be honest, Kurt, I haven't had one conversation with somebody in the last 20 years when they tell me that they think taxes are going down in the future. So yeah, it's a great way to really kind of get people laser focused on this diversification idea.
It really does. It really does. And I think that really highlights the need for diversification.
Yeah, I mean, I agree, because if most of the clients' current assets are sitting in buckets that are going to be taxed when gains are realized or funds are taken out of the retirement plan, and most clients are likely to think that taxes are going up in the future, it really does make quite a bit of sense to engage the client in a more substantive discussion around diversification, not just from an asset perspective, but also from a tax perspective.
Yeah, that's a good point. I think that really brings us back to where we started, that advisors need to determine the right amount of protection that's needed for each individual client.
Yeah, and I think from there, look, once you've established the need for death benefit protection, and it's been clearly defined, then within that need, the appropriate amount of permanent insurance has been identified as well. Clients are going to find that properly owned, structured, funded, and even properly accessed, should the need for death benefit protection diminish in the future, cash value life insurance can be one of the most powerful assets they ever own. And so while providing death benefit protection is fundamental to any life insurance sale, I wouldn't be doing my job if I didn't ask your advisors to take a look at our suite of participating whole life insurance products from MassMutual, which may provide clients with a diversified financial solution that is not subject to the same interest inflation and market volatility as other assets they own.
Well, as I think back over the last several minutes that we've been together, this has really been excellent discussion. Now, I'd like to remind viewers that at DBS, of course, we're here to help each and every one of you to really find the appropriate solutions for your clients. And we would include, when appropriate, a discussion of Mass Mutual. Our team is fully capable and understanding. And we also have highly trained experts that can do case design support and give you the supporting documents and really just-in-time training that you need for those client conversations. We have our advanced markets team led by Terry Getman that can help you with more of those complex conversations. So after the call, what I'd suggest is reach out to your regional sales director or your case design analyst, and let's discuss what's your next case. How can we help you help your clients have a flexible retirement? Vern, I just want to thank you so much for joining us today and want to ask if you have any final words.
Well, first of all, I just want to say thank you to you and your entire team at DBS. You guys do great work for your advisors, and they are fortunate to be able to work with you. Secondly, thank you for the time today. I love having these discussions, and certainly you and I have known each other a long time, and this is our first time being able to do this type of a session together. So just on behalf of the entire team at Mass Mutual Strategic Distributors, thank you for that time today. We certainly look forward to partnering with you and your financial professionals there at DBS as you guys look to create a more consistent, predictable outcome for every client that you guys interact with.
That sounds fantastic. Vern, I hope to see you again real soon. And to each and every one of you out there, thank you again for joining us for another edition of Insurance Insight. We hope to see you again real soon. And until next time, be well, take care, be safe, everyone.